In this chapter, we will talk about the effect of working capital on cash flows. Remember that we are trying to convert profits into cash flows. Now, working capital is defined as current assets minus current liabilities. Current assets mainly include account receivable, that is, money due from customers, and inventory, and current liabilities mainly include account payable, that means money due to suppliers. So now it's easy to see how working capital affects cash flows. For example, a company that has made a sale but has not yet received money from its customers is likely to have a large account receivable. So as account receivable grows, cash from operations reduces, even though the company may have profits because it has made the sale. So account receivable and inventory lock up cash. They reduce the cash flow to the company. On the other hand, an increase in account payable means that the company is not paying its suppliers or at least delaying payments to its suppliers, and this has a positive effect on the cash flows to the company. So an increase in account payable therefore increases cash flows to the company. So a company that tries to enhance its cash flows should try to squeeze or minimize the current assets and expand its current liabilities, or in other words, delay payments. So, increase in working capital can be caused by an increase in account receivable because it implies delayed payments from customers. And likewise, increase in inventory can also mean cash is locked up in the inventory, and therefore cash flow from operations get reduced. And therefore, in general, an increase in working capital results in reduced operating cash flows. Now, a reduction in working capital, conversely, results in increased operating cash flows. So, to repeat a point that we made earlier, profit is based on revenues and expenses, not on payment and collection. And therefore, profit is not affected by changes in working capital. Only cash flows are affected by changes in working capital. So to convert profit to cash flows, suppose we start with the profit after tax, any decrease in working capital needs to be added back to the profit after tax in order to arrive at operating cash flows. But if there has been an increase in working capital, that must be subtracted from the profit after tax to arrive at operating cash flows. Note the words here, decrease and increase. So what we are talking about is the decrease or increase by the end of a certain accounting period relative to the number at the beginning of the accounting period. So for example, if you are calculating profit after tax for a certain year, then the working capital changes that we consider here, be they increase or decrease, are the increase or decrease at the end of that year compared to the beginning of that year. Now, of course, the conclusions above are based on the assumption of zero depreciation and amortization, but we can take the working capital change and the depreciation and amortization together in order to arrive at this big picture. So we start with the net profit after tax and we add the depreciation and amortization. We minus the increase in working capital and we arrive at the cash flow from operation. Conversely, we can start with the net profit after tax, add the depreciation and amortization, and add the decrease in working capital to arrive from the cash flow from operation. So whether you add the working capital or you minus the working capital depends on whether the working capital has decreased or increased.